This is Terrence Orange, your banks with Information Age Financial Solutions, coming to you new year about housing again. And I came across this article, interesting article from LibertyNation.com. Not a place that I visit that often. Actually, I really don't visit at all. But when you see titles like this, Subprime will be back in a vengeance in 2020. For those who are not aware, subprime crisis of housing was what got us into the last one in 2008. It seemed like his history just repeats itself again. But it's a little bit more deeper. It looks in terms of cars as well as the housing. And it's just something very interesting to take a look forward to in that point. So as always, I'm going to put a link inside the description. Dive right in. One of the lasting legacies of the economic collapse a decade ago is subprime. After lying dormant for several years in the aftermath of the Great Recession, the subprime market has returned with a vengeance. Everything is subprime nowadays as banks, finance companies, and unconventional lenders are less averse to risk and are willing to extend credit to consumers with low FICO scores and inadequate incomes. This played out before in the last crash. That's why I really bring it to my attention, and it was really worth taking the time for you to take a look at it and read it. Again, as I mentioned before, I'm going to put the link inside the description. As the great Yogi Berra used to say, it's deja vu all over again. In the moody for subprime. If you have poor credit and interest in a home that is above your pay grade, then have no fear. Moody's Investor Services is out with a new report that predicts mortgage lenders will loosen their standards in 2020. It is anticipated to be a lot easier for borrowers with bad credit to purchase a house as financial institutions attempt to offset the decline in affordable housing options. Will the housing market be drowning in so-called liar loans, minimal income, and document verification over the next 12 months? Not quite, but Moody's analyst Donna Lee wrote in the firm's outlook that there will be a high percentage of loans with limited or alternative documentation. What alternative documentation is. Well, that sounds interesting. Although most of the 11 trillion mortgage finance market consists of tight underwriting standards, you can anticipate an influx of unconventional loans that briefly exited the market following the housing crash. This means that new originators and issuers will set up shop and conduct transactions that are supported by closed-end second mortgages, home equity lines of credit, HELOCs, and loans backed by manufactured homes. When you factor in banks lowering their down payment requirements and Fannie Mae and Freddie Mac scooping up greater mortgages, the prognostications are most likely accurate. Plus, the increase in the number of consumers slipping into the subprime category has been steadily going up. Deutsche Bank data show a drop in credit scores for borrowers between the ages of 30 and 59. But that is not all. The forecast also suggests that many of the subprime mortgages will be packaged into bond agreements without government financing. While Moody's stopped short of citing a number, Bank of America global research analysts projected $32 billion in bond issuance in 2020, up $9 billion from 2018. Subprime losing less standards and mortgage-based securities and yet since 2006 all over again. Reviving up the subprime auto loans. So it's not just limited to real estate. Subprime is going to the cars, which is, I've talked about this before in other videos, but this is interesting to report again. Subprimes are prevalent in every facet of the credit industry. Indeed, we should be terrified of subprime mortgages, linked to another day of reckoning. However, it is the subprime auto loan market that could be one of the drivers of the next financial crisis, and we're beginning to see the warning signs of a crash. As Liberty Nation reported, subprime accounts for approximately 1/3 of the overall auto loan market. In the first half of 2019, a fifth of new auto loans went to subprime borrowers, totaling roughly $61 billion. So far, the results have not been pretty, as more consumers are defaulting within the first few months of borrowing, leading to those loans being packaged into bonds. So not only are they defaulting the first couple months, that means consumers tapped out. Standard Consumer USA Holdings, one of the biggest subprime auto lenders, is witnessing a growing percentage of subprime auto loans defaulting at the fastest pace since 2008. Banks and finance companies are adding fuel to the fire by increasing the length of these auto loans. Today, the average subprime new car loan is 72.9 months. Some loan terms have reached 84 months. This signals that lenders are willing to take on more risk by waiting longer to be repaid. What has happened, however, is a dramatic spike in underwater trade-ins, known as a trade-in treadmill, which are vehicles that have little to no equity. Investors may need to prepare for a head-on collision with this segment of the financial market. I'm optimist subprime. The deteriorating credit conditions may surprise a lot of observers because of the booming economy. Despite more scores slipping and the quality of reports tumbling, credit demand remains strong as consumers continue to grow larger on debt. Total consumer debt jumped $18.6 billion on October, double from September. A recent Federal Reserve Bank of New York FRBNY report has also noticed an interesting trend. Rejection rates for credit cards, mortgages, and mortgage refinancing have declined compared to last year. Lenders enabled by the central bank's easy money policies are satisfying the appetites of these debt-addicted consumers, even if they cannot afford it. Does it come as a shock that across the board delinquency rates are incrementally rising? The only solution to this, it seems, is to feed the beast until its belly explodes. Well said. Take a look at this article. It's got some good tips in there. I'm not familiar with the particular website, but when you look at subprime and knowing that it was a huge crisis last time, it's definitely worth paying your attention. If this video has been of value to you, please subscribe, leave some comments, hit the like button, and as always, I'm out. Until my next video, I'm out.